The other one is some people will say, well, what I'll do is I will just put my children joint on all the accounts. But if we are going to do that, then we normally would take the option of setting it up as a joint ownership with rights of survivorship. And all that means is if something happens to one of us, the other one gets the asset. Because sometimes if we own things jointly, for example, like a business where we each own 50%, if it's not with rights of survivorship, then that other owner's 50% can go to their children. It can go to their heirs, whoever they choose to. But if we set it up with rights of survivorship, then whatever is left goes to the other owner. And so we can set up our accounts in a lot of ways with this. You just talk to your estate attorney. And what you're able to do is you could co-own bank accounts, you can co-own property and other assets. It is worth mentioning, as we mentioned earlier, this isn't ideal for every relationship. And so you do want to take a step back and look at the tax consequences of such an event. And all we're basically saying is you're not able to just have $1 million in an account and then just add your kid to it. And the government's like, oh, for sure, you were a part of this $1 million in the account. In many ways, the government is like, I believe you're just gifting this to them and you're trying to put one over on us. So depending on that person's relationship and how much was in the account when you added them versus how much they contributed into the account, there are times that it creates a taxable event and the government is going to consider it a gift. It is a case-by-case basis with joint ownership with rights of survivorship.